Nothing. Nothing but. Nothing but net. Net.
Welcome to Nothing But Net, the podcast for triple net commercial real estate investing. Before we get into the meat of today's show, let's recap on why there's so much interest and buzz around net properties. Triple net properties are commercial real estate investments where the tenants, usually brand name corporations, pay you rent every month. Can you say mailbox money? In addition, they pay the real estate taxes, insurance, and maintenance for the property. No toilets, termites, or taxes. What's not to like? You can remember what net or triple net stands for by using TIM, taxes, insurance, and maintenance. With triple net properties, there's lower risk income and cash flow because rents are guaranteed by strong credit tenants. Preservation of wealth, because rent increases and property appreciation are bulwarks against inflation and a great store of value. Tax efficiency. The government wants investment in commercial real estate, so they provide inducements through depreciation and deductions which shelter income from taxation. Tax deferral, which gives potential for infinite tax deferral with 1031 exchanges, which are very popular in the triple net space. Triple net properties are a tangible asset, and as Mark Twain once said, buy land. They ain't making any more of it. Hello and welcome to another episode of Nothing But Net. I'm your host, Adam Carswell, joined by our co-host, Michael Flight today. Michael, welcome back. Today we're going to be talking about credit ratings and what an investment grade means. So I hope you're excited and ready to go.
Oh, there's nothing that gets me more excited than credit ratings.
And so previous episodes also, Michael, we went over creating your acquisition criteria, and learning more about, the state of the market by speaking to people who are reputable in the triple net sector. And you really start honing in on properties once you've targeted those areas. But what's next?
Well, I think at this point, I would kind of like to circle back to our acquisition criteria because there was a small little thing I missed, and then we can move on. You choose a market for overall growth rate in economic prospects. And what I've been seeing, especially during this, we're recording this at the time of COVID, we've seen some wildly differing reactions to that from local governments. So I think it's important that we do talk about local governments, and especially now, we're also seeing people talking about abolition of private property and things that I would think are crazy and are antithetical to what the United States is all about and what's made it great. The rage right now in institutional investing is a thing called ESG, which stands for environmental, social, and governance. And the governance part is really the governance part of corporations because the ESG standards are created by the United Nations. But I think we need to really hone in on and concentrate a little bit more on governance for, the municipalities, governments for states, and governments for countries, and how that can severely impact your choices. Also, whether you make money, whether you get a lot of your property confiscated through takings, whether they be eminent domain or things like that. So you should also look very long and hard at, are they pro-growth? Are they pro-property owner? Are they, because if it is, and if there's a situation there, it's best for everybody. It's best for their citizens. It's best for the companies that operate there. And we're not saying to, operate dangerously like juggling chainsaws or anything like that. We do need to have not a bunch of stifling regulations. So I think we need to pay more attention to government. We want good government. We want government that respects property rights. And we want to make sure that the government returns this responsibility to property owners and areas so that it creates growth and flourishing communities. And I've said, I've had properties in Illinois, California, and places out in the Northeast. And some of the restrictions that they place on your property, it makes it difficult, if not impossible, to operate. And then we've had areas or towns where they were running out of money because they had unfunded pension liabilities or whatever. And so they just looked at the commercial properties as a source of extra revenue. So they would just go out and inspect the property on a periodic basis, and they'd always find problems with the property, or it wasn't up to date. And most municipalities, if you pull a building permit, they'll require you to bring it up to current code. Whereas this municipality would just find things not in current code and then say, oh, by the way, you not only have to apply for a building permit to fix this, but your contractor has to be licensed in the municipality. So it was a little like dealing with the Sopranos. They would just come in and extort money from you, it seemed like, whenever they needed it. So anyway, a major factor in your acquisition criteria should be government type, government temperament, and government regulations. Look for pro-growth. Look for people that want to work with you and want to solve problems. And if you can all avoid those places that are spiraling downwards. So with that, I'll throw it back to you, Adam.
Well, I really appreciate you going into the detail there, because I know that's something I think most people probably haven't heard of. I know it's something in regards to acquisition criteria. You don't hear people normally mention that aspect, so that's very helpful. I know you've also written and spoken on property and the right to have private property, so we'll have to do another episode just on that topic as well.
Yeah, don't get me on that hobby horse. But I guess if you're in the property business, the property management business, the property investment business, you should know a slight amount about the right to own property and private property.
And I believe you said this before, but the three most important factors in successful single tenant net lease investing are location, credit quality, and tenant brand name strength. Is that accurate?
You are the man who keeps remembering the stuff that comes out of my mouth, so I appreciate that.
All right. Well, I heard you describe single tenant net lease investments many times, bonds wrapped in real estate. So could you elaborate a bit more on what that means?
Yeah, just to follow up on your previous question, we'll talk more about location in an upcoming episode, which we will also have visuals, and it'll be on YouTube where you can see us break down an offering memorandum. But
visuals, nice. That sounds like an experience.
I'm hoping it will be. So, we'll see how the technology works. But a single tenant lease, or sometimes called a net lease, or you see it abbreviated as NNN, property investment has many of the characteristics of buying a bond. We like to say that net eliminates toilets, termites, and tenant complaints. The investment grade part of the net lease properties is where you get the bond type of thing, because corporations, especially larger corporations, when they float bond issues, you'll have rating agencies rate the bonds to give you a financial outlook, and are they capable of paying this bond back, or are they likely to default on this? And so that's where we get investment grade. It's sometimes abbreviated IG. And those investment grades come from Moody's, Standard & Poor, AM Best, and Fitch. There's also other ones out there. And for every country, they have a different rating agencies too. But those are the biggest here. And people really pay attention in the net lease space to Moody's and Standard & Poor. So those are the things to consider.
Okay, so if I'm hearing it correctly, a credit rating is an assessment of the credit worthiness of a borrower or tenant.
That's correct, Adam. Think of it this way. A credit rating is just like an individual, for FICO scores, where you have credit bureaus such as Experian and TransUnion, and also Fair Isaac, which is where you get the FICO score. You run those on individual tenants. So if you were operating an apartment, you'd want to know if that tenant is going to be able to repay. With those, the scores range from 300 to extremely poor to 850 extremely good credit. So you have a likelihood that the tenant is going to pay rent. So if we're familiar with that, the Moody's, Standard & Poor's, AM Best, and Fitch also do the same thing. They do it with corporations. Naturally, when we're looking to invest, we'd want an excellent or great credit score, whether it's an individual or a business or government. And a key thing here is the credit rating also is a factor in the price of the property. So a higher credit rating, like and we'll get into what those are later, but a higher credit rating or a higher credit tenant, you would pay more for that tenant. You'd actually have a lower cap rate for those type of tenants because they would have the most likelihood of repaying. Just like a borrower, if you were borrowing money on your house, or if a corporation was going to go out and borrow money, if they have a high likelihood and have a good credit rating and have paid as expected in the past, and have liquid reserves to pay in case they get into a problem, those people get better interest rates, so they pay lower interest rates. And so that's the same thing. If you're buying a really great credit tenant, and as I said, we'll get into those later, you're going to receive a lower interest rate on your money. If you're taking a risk on a tenant and the tenant, goes into junk bond territory, or it's a individual, you're going to get a much higher cap rate, or you should not pay a low cap rate for that type of tenant.
Gotcha. It's interesting how it's tied to cap rates. It's something I never considered either, but makes a lot of sense. And I don't know, I always think of, I know we've used this as an example before, but like Chick-fil-A has a really low cap rate. And so that would tie to the fact that they probably have like a AAA rating.
I actually, you caught me on that one because I don't know what Chick-fil-A's credit rating is, but the reason that they have such a low cap rate on their properties right now is because they produce the highest volume per store and per square foot in sales. So you have a high likelihood that that tenant is going to be there and that tenant is going to pay you rent because they just crank sales. Out of all the fast food restaurants, they're the highest per store in terms of sales per store and also sales per square foot. And another thing, Starbucks used to be like really high up there in sales per square foot volume. They've reduced that a lot because there's just a Starbucks on every corner. So you're not going to have as much sales volume per store because the stores, if you get them too close together, they cannibalize the stores. That's why you got to be very careful with like a Subway because, again, Subways are on every block. And that's one of the reasons why you get a higher cap rate with Chick-fil-A is because they're not everywhere. They're not ubiquitous. They don't have anywhere near the amount of restaurants that McDonald's or some of the other guys have too. Plus, they have good food, so people go there and pay a lot for it.
Well, switching back over to the credit scores, they're a little bit different than a FICO score. So how do you compare the two?
Well, an investment grade rating signifies that a municipal or corporate bond presents a relatively low risk of default. And so bond rating firms like Standard & Poor's, Moody's, and Fitch use different designations consisting of upper and lowercase letters to identify. So you'll always hear, well, I can't say this, but a lot of times in the triple net community, as you keep doing it more and more, you'll hear, oh, this is a AAA credit. This is a AAA credit. And what that means is that, Standard & Poor's, it's a capital AAA. That's your highest credit rating. For Moody's, it's an A, capital A, and then small a. And so those are, typically like the U.S. government. The equivalent FICO score, that would be somewhere around like an 850 FICO score. And then you get down to the AA2 for Moody's, and then you get AA or just capital AA for Standard & Poor's. And with Fitch and AM Best, it's AA or AA minus. And then going down further, if you figure like a FICO score in the range of 775 to 800, that would be the equivalent of an A3 for Moody's, an AA minus for Fitch and Standard & Poor's, and a small A minus for AM Best. And then it just goes down from there. So the next ones are Bs. So you get triple Bs, and then the much riskier Bs are single Bs or B3. And then when you get into Cs, those are junk. A lot of institutions, like, so for example, people set their investment criteria that they'll only invest in companies that are triple A through B or B1. And those are all investment grades. Actually, B and triple B are investment grade. And so they'll say, I only want investment grade tenants. And then there's other people that'll say, well, I'll take a flyer on like a C, CCC, C minus, and those are like 580 FICO credit scores. The reason why they would do that is because, again, they might be willing to accept higher risk because they have the ability to release the space. If the tenant goes into bankruptcy, they might look at it as more of a value add play, and the value add is on the purchase. Let's say that we're talking about McDonald's, Starbucks, or Chick-fil-A, and those are all, somewhere in the 4.5 cap to 5 cap, maybe 5.5 cap, depending on, the location that they're in. And then you go down to a guy that's like an individual. Adam, tell me what a bad restaurant is right now. I don't know.
Well, that's what I was getting ready to ask you, if you could give an example for each different rating. But a restaurant that's struggling right now, you know what? I think there's a place here in Canada called like Pizza Express, and I went by it the other day. It looked like they were just barely open.
Yeah, well, I can't tell you. Right now, dine-in restaurants which own Applebee's and IHOP really, really struggling. They're on the bubble. They're, as of right now, at the time of this recording, because of COVID and because they just had operational problems over the past few years, they're close to bankruptcy. So that would be highly speculative. So if somebody brought you one of those deals and they said, oh, we're bringing this out at a 6 cap, you would say, get out of here. What are you, high? Because that tenant has a real likelihood of going into bankruptcy. So you're going to want to price in some risk there. You would say, I think this tenant, it's also, like I say, there's a number of factors that go into the cap rate. But one of them definitely is the credit rating. If it is a location that you think that you can, release, you might decide to take a risk on that. But you also have to understand that if that tenant goes into bankruptcy, you're going to have additional cost of dealing with a bankruptcy court. You're going to have to wait to see if the tenant rejects their leases, because they have the right to reject their leases, or if they just decide to sell the entire, and you might get another tenant that might be way better than the current tenant, or you might get a tenant that is a noxious use that you don't want. Like I've seen it where it's like the tenant goes bankrupt and you get like this closeout store that is just sells a bunch of junk. I saw one where the tenant went bankrupt and they were bought by a adult bookstore chain. That's, it's like, okay, now all of a sudden you've got this noxious use, and did you sign up for that? So that's the type of thing that you should be aware of with that.
Okay. Well, yeah, thank you for the examples. That really does help. Like, I guess, does that cover investment grade? Is there anything else special about investment grade that we would need to cover?
I think, like I said, the investment grade, you have a high surety of getting repaid. So as of right now, publicly traded companies like CVS, Walgreens, Walmart, and Amazon, and McDonald's are probably like your highest likelihood of getting paid right now, just because they have such high valuations and they've got a lot of cash to cover, weather a storm, and they've been through ups and downs, except for Amazon. But Amazon, this particular pandemic was ideally suited for them. So right. Don't get into all your conspiracy theories either, Adam. So
if a credit rating is essentially the same as a bond rating, then why would you not just invest in a bond?
Glad you asked that question. Number one, because I'm in real estate. But really, real estate is a much better situation than bonds. Number one, bonds are treated differently for tax treatment. But number two, real estate is a tangible asset. So at the end of a bond, you just get paid off and you get your money back. With real estate, at the end of the lease, if it's a really great location, there's the opportunity to add value to it. There's the opportunity to hold it for generations and generations. We have a Walgreens that has been at the shopping center and is on an out parcel now. And they've been there. They signed the lease like in 1955. They opened the store in 1957, and they have another 50 years. Do I expect Walgreens to be in business for 50 years? I sure hope they will be. They might not be in the same business. They might change a little bit, and they might be more of a health convenience store type of thing, which it seems to be the way they're going. And they're adding clinics and things like that. So as long as they can keep up with the market and what the market wants, the great thing about those properties is they are insanely well located. So if you're buying a Walgreens, you know that it's going to be on a main corner. What I really like to tell people is there was a recent movie about Ray Kroc. It's called The Founder. And there's a little section in there that the guy, his accountant is talking to Ray Kroc, and Ray Kroc is completely broke and it's not making any sense. He doesn't have control over his franchisees. And the accountant just says to him, he goes, well, wait a second. If you can't control the franchisees and you're going to make all your money in selling the stuff, your real business should be the real estate business. You're in the real estate business. And so from that, Ray Kroc went out and got all the best locations. So for a while there, all the way up through like the 2000s, before McDonald's got pretty saturated, McDonald's were always what we call main locations. And then the other thing about McDonald's is once McDonald's went there, everybody else knew that McDonald's did this extensive amount of research into that location, and they knew that that was a AAA location. So once McDonald's went there, then you saw the Wendy's, the Burger Kings, and actually, retail developers would build over there too, because they knew that McDonald's, put a lot of research into it, and that was a good location. One, you get a tangible asset, you get a really good asset. Number two, the investor has a portion of the income sheltered through depreciation, through any expense write-offs, and through if you've got a mortgage on the property, you can use the mortgage interest as tax deductible. So you can't leverage a bond. So if you had $100,000, you would have to pay $100,000 for the bond, or you'd buy some bonds work the other way where you pay, and then at the end of the thing, you get paid up 100%. But anyway, you are paying like a savings bond works. You pay a certain amount, and then at the end of the term, the savings bond pays you back the full amount. But with real estate, you can leverage it. So you say, okay, I got this McDonald's that I'm buying, and since they have such a great credit, then I can go out and borrow money. The other thing is you might not need to sign personally based on if you've got a credit tenant, the bank will just accept the fact that and you've got a lease with that tenant, the bank will take that. So you can leverage it 50, 75%. So you could only have 25%. So $25,000 or $250,000 into $1 million property. So that's, another great thing about, net leases. And then the other thing is, bond rates are much lower or bond returns are lower than real estate returns because it's easier to hold a bond and it's easier to trade a bond, and real estate is a little less liquid. So you get a premium for less liquid and you get paid less money for being more liquid. What we really like about real estate is slow to go up and it's slow to go down. And so you get something that's just going to be stable there. Plus you get much higher returns than you would with a bond. So those are just kind of the things that, and then if we're comparing muni bonds, because muni bonds are tax-free, the interest, but I would really be concerned about, investing in this, as you heard my rant earlier in the podcast, I'd be very concerned that some of these governments have these pension fund liabilities and have other liabilities, or they have shrinking populations. And they might, you've got to be very careful. You're getting a paltry return and you're taking a lot of risk. At some point, I'd rather invest in a junk bond than some of these municipalities. I can, mention my hometown of Chicago. There's no way I would touch those. So anyway, that's what we have for net lease properties, which in my opinion, and we don't give financial advice or anything like that, but in my opinion, net lease properties are head and shoulders above bonds and muni bonds.
Yeah. And I mean, you've made so many points there to make that clear. And another one that, that comes to mind for me is you look at just something as simple as like inflation rates too. That would make a much stronger impact on an investment in a bond than a real estate investment.
Yes.
And so lastly, the brand is really important. So what can you tell us about the brand in this regard?
Especially with retail. So this part specifically applies to retail, but you can kind of apply it if you were doing triple net office or triple net, warehousing too. But the brand is very important because if they have a good brand, number one, people will pay more money for a good brand, a name brand. As you can see, that's why they have a name brand. That's why people pay extra for the Michael Jordan shoes, versus regular shoes just off the rack. But the other thing is a brand name, if they're putting the marketing into that name, that they're expending money and expending effort to make that success. And so with the brand is important. And so you can take a chance on a smaller brand, and we've taken chances on, people that had like 1 to 2 to 3 stores. And next thing you know, they blew up, and they were one of them right now is like a 150 store chain. So it was cool to meet with the founder when they were at store 3 and, sit down and eat a lunch with them and get a lease done. And now it's like the kids are running the company, and it's just this fantastic brand, and it's really cool. So like I say, you want somebody that is good at operating the company, good. You don't want a brand that, they're known for cutting corners and stuff like that, because that could actually bankrupt the company. So you just need to be aware of the brand, and that if it's a good brand, that they're going to be burnishing the value of your property too. So as I said before, I don't know what Chick-fil-A's credit rating is, but I do know that the Chick-fil-A brand, people, line up, around the block to get their chicken. And that's why they have the highest sales per unit in the quick service restaurant area. Everybody knows who McDonald's is. They're worldwide. So that's the type of thing that you're looking for, something that's a solid brand. And you could also, if you wanted to get a little more sophisticated, go with, a local brand. If there's a local brand in a market that that's growing, they have a good name for themselves. I mean, look at Keller Williams. They don't do triple net leases, but they were, I think, a 30 or 40, in Texas, in the Austin area, and I'm trying to think of offices, and they just exploded. And Gary Keller blew that brand up, and I think they're like worldwide now. They're just and they continue to grow, and they have people asking them to join the Keller Williams name because they know that the Keller Williams name, it just brings with it all this stuff. So that's what I'm saying. Brand is also a thing. And so the next time we talk, we will talk a lot more about the third important thing, which I believe is probably the most important thing, but it's easier to explain these other 2 things first, and then we'll go into location.
All right, Michael. Well, looking forward to the next episode and diving into offering memorandums, as you mentioned, the visual experience that we're going to be looking forward to, and then also looking forward to learning more about location.
Hey, thank you very much, Adam, for the opportunity to talk with you today. I really, it helps me express some of the stuff and why we're so excited about net lease properties, and why libertyfund.io is something that we believe is just going to get bigger and bigger and better and better. So thank you very much, Adam. Really appreciate your time today.
Thank you, Michael, and thank you everyone for tuning in. Again, remember to check out libertyfund.io if you haven't already, and we will catch you in the next episode. Thank you once again for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. If you enjoyed what you heard today, one last friendly reminder to like, share, subscribe, or leave a review for us. It really helps a ton with the show's visibility. For the Nothing But Net team, I'm Adam Carswell. Take care.
Nothing but net.
The Nothing But Net podcast is not intended to provide legal, tax counsel, or accounting advice. Adam Carswell, Michael Flight, Concordia Realty Corporation, Liberty Real Estate Fund, LLC, and their affiliates do not provide tax, legal, or accounting advice or the worthiness and promotion of any particular investment. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction or undertaking. We highly encourage individuals and investors to seek the counsel of a qualified attorney as well as seek the counsel of a tax professional or certified public accountant to determine if there are any potential tax liabilities or consequences as a result of anything contained herein. All listeners of this podcast or video should understand that there are no guarantees of any success, outcome, or profitability of any transaction or undertaking, expressed or implied, and will not be liable for any financial or other losses or damages incurred as a result of any undertaking. Go to nothingbutnet.us for a complete set of disclosures. Thank you.